So we've started recording. And without further ado, here's Sunny at Personal Tax Advisors. Sunny is so warm and I feel comforted when she speaks, and she makes taxes not seem so scary, which is quite a talent. So we're excited to introduce Sunny Widerman.
Oh, thank you so much. It's good to be back, sort of back. The last time I did one of these, I was in person. This time I'm sitting in my office. But it's so fun because we can welcome so many more people to this meeting compared to last time. And I'm really thrilled to be back doing a session with you guys. So a little bit about myself, like why am I the person here? Um, I did not grow up planning to be the tax lady. I kind of doubt that anybody ever does plan to be the tax lady. Um, Basically, I always wanted to work for myself. I wanted to be a writer. I thought that was a great idea, but of course, it takes a while to make some money at that. And uh, what happened was I went to talk to somebody who was a she called herself a financial therapist. I didn't really need therapy, but she had no advice for me. Instead, she offered me a job as a tax preparer in her tax preparation business. And so I thought, oh, this will be temporary. I'll do this for a few weeks in the spring, and then I will like go on with my life. And that was 2002, and it has been the entire rest of my life. So, didn't plan to be here, but so happy to be here. And one of the reasons I like being here is because from the beginning, I've always worked with self-employed people and with creatives in self-employment, that primarily with, writers, artists, performing artists, that sort of thing. I love the entrepreneurial spirit of people who are self-employed, and that the sort of the need to be very actively engaged in what you do for a living. It's different from being an employee. And of course, I love creative people because they're the most fun. So this is kind of bringing together everything that I love. I love teaching. I love helping people stay out of trouble. And I love working with creative, self-employed people. So here we all are. Now, that said, um, I do a lot of these talks. I do this talk or variations of this talk or aspects of, I do webinars and seminars and workshops about this topic a lot. And the question is, why? And I don't always get paid. I mean, I hope to, but I don't always get paid. I still do them a lot. Why? And I'm going to explain this by telling a little story. Um, I we got an email one time a few years ago. We got it by in the fall, so it wasn't really tax season. But it was this person. She was a self-employed creative. She was actually an actor. She had made modest money, small to modest, for her entire career, but she hadn't been filing tax returns. And the Canada Revenue Agency will let that go for a while, but after a while, they wanted to see those tax returns. So they wrote her a letter asking her to file her returns, which she ignored because tax preparation is scary and she's a creative and this isn't what she does and she didn't want to. And so CRA did what they usually do in that situation, which is that they write another letter and asking her again to please file this return or file these returns, which she ignored again. And they sent another letter, which she ignored again. And finally, they said, okay, if you're not going to file, we're just going to put together returns for you. And they don't have, CRA did not have enough information to file an accurate return for her, but that's no longer what they're trying to do. At this point, if they ask for a return enough times and then you don't file, they just make something up. And it's usually not a great return from your perspective. It's kind of one that's going to overstate how much you earned or understate your deductions. And basically, you're going to owe some tax. And that's called, we used to call it an arbitrary assessment. CRA's technical term for it is a notional assessment. And that, even though it's made up, and even though they know it's made up, that stands as your tax return And the bill that it generates is your tax bill, even though it's all made up, um, unless you file a return. Because if you file over top of one of their returns, they will immediately yoink their return and put your return in place. So if they've filed for you and you go like that's not accurate, and you file your own version that shows, less tax or whatever, they will accept that and they will ditch what they have, because that's really what they wanted, the actual return. They didn't want a notional return. It's just they didn't have the real one. So when she came to us, she really wanted to get those returns filed to bring down that tax bill and start to sort of figure out what to do about it all. So, we put together a package price for her. You know, with every discount I could think to give her, with every possible break that I could think up for her, um, 10 years of tax preparation, even at the lowest possible price, it's not going to be cheap to do 10 years worth. And so we presented her with an estimate and to see what she thought about it, and we never heard back, which is, of course, not that surprising. She had never made a lot of money as an artist, and now we were like saying, like, here's what it'll cost to do 10 years worth of tax preparation. And then to our amazement, she responded actually a few weeks later. She came back and she said, I'm sorry that I didn't get back to you sooner. Um, but I was busy because I've been evicted. And another thing that had happened to her, another reason why she wanted to file, was because CRA, with this new tax bill, had decided to garnish her wages. So a garnishment, as you may know, is basically CRA gets a court order to divert the money you earn as you earn it to themselves. They do need a court order for it, so a lot has to happen before it gets to this point, but it had gotten to this point with this woman. So they basically contact everybody they know that may be paying her. Any job she might, if she's working for a production company and they know about this production company, they contact the production company, everybody who might pay her legally, and say, we have a court order here that says that you must divert income directly to us before it gets to her, because that's the way it goes. That's a garnishment. Now, in the chat, if you would, does anybody want to take a guess at what percentage of her income they wanted diverted to them? They had a court order to do this. What percentage of every dollar she earned? 25%, 30%, 15, 50, 60. Okay. Anybody else have a guess? The person who gets closest wins bragging rights here. So it's super important. Oh, Nick M 61. Like, you're like, this is not the Price is Right. Nevertheless, if it were the Price is Right, oh man, Naomi, you live in a cruel world. John Hill. Okay. All right. All right. Votes are closing in 5, 4, 3, 2, 1. The actual percentage that was being garnished and diverted to the government before she could have any of it was actually 100%. So Naomi C got it. Every dollar that she could legally earn was going straight to the government, not her. And this was going to happen until she brought that tax bill down or filed a return. So this is why she wanted these returns filed. And now she'd been evicted. So here she is, unable to earn legal money, and she doesn't have a home. And this is what we call, and I don't like to drown you in jargon, but here in the tax business, we call that a disaster. This is terrible. This is very, very, very bad. Very bad. And what breaks my heart, I don't know if the CPP can be garnished, by the way. Somebody has asked about that. I don't know. But what breaks my heart about this situation was how, I don't want to say easy, but she could have avoided this if she had known what the stakes were. And the amount of effort that it required was within her ability. The amount of effort that was required was within her ability. And I'm sure that if she had understood what the stakes were, she would have been doing it. It was preventable. And the reason that I do so many of these talks is because I don't want this to happen to anybody if it doesn't have to happen. Right. And my hope by the end of this session is that you'll be armed with enough knowledge, understanding both the stakes, which now you understand the stakes, and also the amount of effort that is required to not be in this situation. This is not going to happen to you. This is not going to happen to you going forward because of what you're going to learn tonight. That makes this very worthwhile to me as a use of my time on a Thursday night, because I don't want this to happen to you. Now, that said, it is possible that it has already happened to some of you, and you actually do find yourself as a cat in the Venetian blinds. If that's a situation for you, I do have a guide to help you walk through that. There's a link here. I will put up this link again later in the talk. So don't worry about it if you don't get it this second. I'll send it out again for you. But basically, there is a way forward. It does require effort. It does require work, but it is doable. We have worked with clients who are 10, 20 years behind in their tax filing. We can help you. It can be done. It's just, there's some work to be done. So just know that. And it is more work than it would have been to stay out of this trouble. So that we're going to talk tonight about how to stay out of this trouble going forward. But if you're in this trouble, there is a way forward. And I also want to point out that I am going to give you some links to some resources. A lot of the sort of technical details I'm going to give you right now are in these resources. So I don't want you to go sort of crazy writing everything down, because it's been written down already and you can just get a copy. And again, I will share links to that later in the presentation. So don't worry too much about it. You can just sort of relax and sort of listen and, think about stuff instead of like getting writer's cramp over this. And now we go. Questions. Taxes are terrifying. Yeah, I know. Would they have also charged interest and penalty on that? They charge, so CRA does charge penalties on late filed things, and they charge interest on late payments, and we'll talk about that later as well. So welcome to the wonderful world of self-employment. And you'll notice that this is off-road, because that is the key here. A lot of the information that's out there is really geared toward people who have a regular job, a job. When I talk about employment, I mean a salaried job where you go, you show up, and you get paid for your hours, and then you go home. That's employment. But what we're going to talk about tonight is self-employment, which is where you're the boss. You invoice people. You don't get a salary. Instead, you bill people for what you do. And for the artistic part of your lives, most of you are in that situation. You're freelancers, you're self-employed, and it is an off-road place where there's a little less information and where also there are a lot more options for you. So there's more to know. There's more choices as well. It's just like driving off-road. And the key about being self-employed is that not only are you off-road, but you are the driver on this road trip, not the passenger. Employees are like passengers. Self-employed people are drivers. And what that means is that you get a lot of choices. You get to choose when you start, when you stop, where you go. That's analogous to what kind of projects you want to take on. But at the same time, you never get to sleep. You never get to just coast, right? You always have to be active. That's the problem and the joy of being self-employed. So the main differences between self-employment and employment. When you're self-employed, you do get to keep a little more of your money in your pocket because you get to write off business expenses. That's part of the self-employment deal. You need to know something about the GST-HST. You need to set aside some money for tax during the year, preferably while you're earning it. And you need to keep good records. And you also need to know about filing deadlines, which are, some of them are different from the deadlines that apply to people who are employees. And also you may have more things to file than an employee. So you just have more deadlines to know, and they're not the deadlines that people are typically talking about. So, quiz question, again, in the chat. Which of these is necessary in order to be able to deduct your business expenses? Do you need a business number or business name? Do you need to be registered to collect HST, GST? Do you need to be incorporated? All of the above or none of the above? Okay. Wow, we're only getting, mostly we're getting the far ends of the spectrum. Most people are saying either all or none. Top two, business number and GST registration. Okay. All right. Okay. A good range of answers. So this makes, when I get a range of answers, then I know it's a good quiz question, because this is the actual answer. You don't need any of it. So all the people who said none, simplicity is the rule here. You do not need any official paperwork, registration, anything at all to deduct business expenses against self-employment. If you are self-employed, and this is very different from employment, you can't really deduct much against employment income. But if you are self-employed, meaning that you're billing somebody for your time or for your products or for your efforts or whatever, you can deduct the expenses that are incurred in order to earn that income. So it's important. They have to be incurred in order to earn the income against which you are deducting them. So if you incur an expense, but it has nothing to do with your self-employment earnings, you can't really deduct it. But yeah, you can't really deduct it. But if you do have an expense that has to do with your business income, you can. So the key with business deductions is, of course, the heavier your deductions are, the lighter your tax bill is. So we want to deduct as much as we are legally allowed to, as much as is reasonable and fair and all that stuff. But what does that mean? Well, one nice thing in self-employment is that there are some expenses that most people are incurring, but if they're not self-employed, they can't write them off. As soon as you have self-employment income, they become fully or partly deductible. So you may have some business deductions that are already sort of sitting there waiting to be used. Once you become self-employed, you can start to use them. For example, if you're using your car to earn income, if you're using a portion of your home from which to work, or if you have a computer, you're almost certainly using it as part of your business. So it is at least partly deductible. So these are expenses. You're not actually incurring new expenses. You already had these expenses, but now they can be used to lighten your tax bill by virtue of the fact that you're self-employed and you need them for that purpose. So beyond these basics, people always want to know, well, what can I write off? Now, the problem is that there is no giant guide, listing every possible purchase alphabetically and saying you can or you cannot deduct it. That does not exist. So there are some expenses like you can't write off golf club memberships, if that was something that you were thinking about. Some people try to write them off because it's like networking, but there's a specific prohibition against club memberships like that, fitness club memberships. But the number of things where there's a specific rule that you can or can't do it is actually quite small. And the number of things that you could potentially spend your money on in an attempt to make more money is actually infinite. Anything you can spend money on could be somebody's business deduction. It all depends on context. So if the Canada Revenue Agency is ever going to debate you on whether or not something is deductible, what they do is they apply a principle to the situation. And if you understand the principle, you can defend your deduction by speaking their language, by giving them the kind of information they want to know. And their principle is this concept of the reasonable expectation of profit. And the reasonable expectation of profit, somebody's mentioned it already in the chat. Reasonable expectation of profit means that you can reasonably expect that the income that you're going to earn by virtue of this business expense will exceed what the business expense cost. So we've got two kind of key things. One is about size. The expense that you're expensing shouldn't be gigantic compared to the income you're trying to earn by spending that money. Right? The expense should be lower. You should be aiming to walk away with a profit here. Otherwise, why are you spending like $1,000 on something to make $100? It doesn't make any sense. It's not a good business move, and that means it's not really a valid business expense. But the other important key here is the word expectation. And the word expectation, what it means is that you can sometimes spend money on something hoping it'll make you some money, and it fails to make you any money, but you expected it to. And that also makes it a reasonable deduction. Like, well, sorry, not reasonable. Let me not use that word yet, but that makes it deductible. Okay. So let's say you buy a piece of software because you think it's going to be really handy and get you some gigs that you otherwise couldn't fulfill. And then as it turns out, you don't really get any of those gigs. You thought you would, but you didn't. So you spent the money and it did not result in any income. It's still a business deduction so long as your expectation that it might make you some money and it might make you more than you paid for it is reasonable. The word reasonable, when CRA uses it, means from the perspective of a reasonable but disinterested party, meaning a person who is of sound mind but does not care either way about whether you're going to deduct it or not, looking at the situation would go, yeah, that was a reasonable expectation of profit, regardless of whether or not it occurred, right? Self-employment is a venture. And like all ventures, you're stepping out and it may or may not work out, right? It is understood that sometimes it works out, sometimes it doesn't. As long as a reasonable person feels like, yeah, it makes sense that you spent that money trying to make some bigger money, then it's allowable. Those are the key principles that CRA is looking for when they talk about what's a reasonable business expense. And I want to also make one more word of caution here. People can be very creative in what they write off. Your friends may be very creative in what they write off. And they may suggest that you write something off that's never occurred to you before and that strikes you as a little, let's say, edgy, a little out there. You know, writing this off doesn't, you don't really know that you didn't spend the money in order to make income, and it seems a little bit iffy. And they say, no, I write it off every year. It's fine. When you file a tax return, CRA actually sees very little of that tax return. They see very little detail. In fact, almost nothing. They see with reference to your self-employment, when you file a tax return electronically, which almost every return is filed electronically now, CRA sees your gross revenue and your net profit. In between that is everything you deducted to bring your profit down to your taxable profit. They don't see any of that when you file. They only see it if they decide to review your return, also known as an audit. So if somebody is suggesting that you write something off and saying that it's going to be okay because they always write it off and it's fine, CRA has never said a word. Well, CRA may have never said a word because they've never actually looked at the return. Ask the person if they've been audited. If they have not been audited, then they don't know if CRA is okay with this. They just know that they've gotten away with it. If they've been audited and CRA was okay with it, well, there you go. But until somebody's been audited, they don't know if CRA is okay with something because CRA has never seen it. Okay, now here's a quiz question I'm going to put up on the screen while I look at some questions. What special tax imposed by Henry VIII, Elizabeth I, and Tsar Peter I could only be levied against men and certain female circus performers? And for a second, I'm just going to look at the questions that we have right now. Oh. Okay. All right. Um, so the question I'm seeing here is I have expenses that were incurred in the past, but I never used them to bring down my income. I never deducted them. Can I deduct them now? Now, and you also mentioned capital expenses, so things like assets, which are things that last for several years, like cameras, computers, cars, those sorts of things. Assets can be written off gradually over a number of years because they help you earn income gradually over a number of years. But other things that you sort of expend in the year and that's it, like a membership, you can't actually use them as a deduction later on. What you can do is you can actually go back to a previously filed return and adjust it. You can enter this figure later. It's a pain to reopen a return and adjust it to add an expense that wasn't there before, but you can do it. You can go back up to 10 years. You can go back and make changes. And it does not necessarily make you more liable to be audited at all. It's just a change. People make changes all the time. So that's one thing I want you to know. So you can't deduct it in a later year. If the expense was incurred in 2023, you can't write it off for the 2025 tax year. You would have to go back to the 2023 return and adjust it. Now, before I go on, here is the link to that first guide. This is the guide to business deductions, talks a little bit about what I've said, also gives you some ideas of the types of business expenses that CRA does sort of expect to see and what their various categories mean. Let me look and see if there's another question I want to answer now. Okay, nothing new here. Do these same deductions principles apply to artist grants that you received from the government? Absolutely. In fact, as we know, the arts world in Canada is heavily involved in grants. But as we also know, if you've gotten grants in the past, what you do is you usually submit a budget for your project, and the grant is meant to cover that budget. So the grant is, in fact, meant to be spent. You're not really meant to have anything left over afterwards to keep for yourself. You might, but you're not really meant to. So yes, you absolutely are going to deduct all the expenses that were incurred in order to fulfill the grant. And if your budget was accurate, that should mean that your expenses almost are equal to the grant, or they're close. Because obviously, if you said, look, this project is going to cost me $10,000 and the Canada Arts Council gives you $10,000, if all has gone properly, you are going to write off $10,000 worth of expenses. And that will leave you with a net profit on that grant of zero, so that you do not pay tax on that grant. But that is only going to happen if you report it as part of your business income and not as other income on line 13000, which is where it's going to automatically go if you don't sort of manually move it over. So if you're an artist and you get a grant, first of all, you want to make sure it's getting declared as part of your business income and not as other income. Sort of there's another line for that. You can ignore that. And then absolutely you want to deduct every expense that went into fulfilling the grant. Okay. You know what? I'm going to stop doing this quiz question because too many people have heard of the beard tax, because that, of course, is exactly what this strange tax was. Different regions or different rulers have imposed it for different reasons. Peter the Great, always looking to westernize and modernize Russia, felt that people, with the long, scraggly beards looked like peasants, and he didn't want to look like that anymore. And so if you wanted to keep looking like that against his wishes, you were going to have to pay for it. The English kings and queens, their idea was that only nobility would be allowed to wear beards. And if you couldn't afford the beard tax, then you weren't noble enough to wear a beard. So that coin-like thing is a beard token. If you paid your beard tax, you got your beard token that you could carry around with you in case somebody saw you with a beard and wanted to challenge you as to whether or not you'd paid your tax. You would reveal your beard token, and that would be your proof that you paid taxes for your beard. Okay. Now, before we get into the next section, I've got another question here. I'm thinking of selling items made from vintage fabrics and selling vintage fabric on Etsy. What are the tax implications on that income? The same as the tax implications of any income. If you are based in Canada, you must report all your worldwide income on your Canadian income tax return. From that, you subtract any of the costs that went into making those sales. So that includes any fees that you paid to Etsy, the purchase of the products yourself to put them up for sale, any marketing that you did, any expenses that you incurred in order to try to sell the product. You subtract those from the income that you ultimately made on the product, and what's left is your net profit. That is taxable. Okay, so always a popular topic. Let's talk about the GST. So before we get into this too deeply, we use these initials all the time, GST, HST, but let's go over it again to make sure we actually know what they mean. The GST is a sales tax that is charged at the federal level. So the country charges a federal sales tax. Then each province has the option to charge its own provincial level sales tax. And that provincial sales tax, so the GST is across the country, it's 5% everywhere, but the PST depends on the province. So the PST in British Columbia, for example, is 7%. The PST in Alberta is 0%. It depends on the province. In some provinces that have a provincial sales tax, in order to simplify the filing and sort of make the rules simpler, have harmonized their provincial sales tax. And what that means is that they have just swept away their own internal provincial rules about sales tax and combined their sales tax with the federal tax into a single tax with one set of rules and one return to file. Those are harmonized sales taxes. So right now, Ontario is harmonized, the Atlantic provinces are harmonized, and the other provinces have gone their own way. We're only going to talk about the GST-HST. In provinces like Ontario, where we have harmonized our provincial sales tax into the federal tax, the rules for the provincial taxes are now identical to the rules, more or less identical to the rules for the federal tax. So whenever I talk about the GST, I also mean the HST. If I talk about the HST, I also mean the GST, because the rules are the same everywhere you go, except only the numbers change, but the rules are the same. So, does this matter to you? Well, it matters to you if you bill more than $30,000 in a 12-month period. Now, I want to specify a few things about this. Only your self-employment income counts toward the 30,000. If you also have an employment, like a job, so especially a lot of artists have like a day job, and then their art is like a second job. Only the self-employment part counts toward the 30,000, number one. Number two, all your self-employment counts toward the 30,000. So if you do some work as an artist and also as a handyman, as a self-employed handyman, both those amounts are combined to see if you hit this $30,000 threshold. All your self-employment is combined. And this other thing is this any 12-month period. So sometimes a 12-month period is not the same as a calendar year. Like let's say you make a bunch of sales in December. So you make $15,000 worth of sales in December, and then you make $15,000 worth of sales in January. So the two amounts are split between 2 calendar years, right? So you didn't make $30,000 in a calendar year, but you did make $30,000 in a 12-month period. It doesn't matter that it's split over the calendar year. So once you've crossed that $30,000 threshold in any 12-month block of time, you are supposed to register for the GST-HST. Now, I know that a lot of people don't want to do that. I am aware of that. I want to demystify the GST system a little bit because actually, in its bones, it's pretty straightforward. It's one of the simpler, not easy, but simpler concepts in tax. So here it is on a single slide. If you are a GST registrant, you charge GST on top of your fees, and that is what you're going to send on to the government. So you're going to charge a tax, hang on to it, and eventually give it to the government. In exchange, when you spend GST or HST on a deductible business expense, you can claim it back from the government. That's the trade-off. You get to have back some of the money that you spend. And to keep track of all this, you need to file regular GST-HST returns to report what you collected and what you spent and explain why you're sending them whatever money you're sending them. So these are the three things. You collect it, you claim it back, you file a return and remit the difference. That's the whole system. Now, I know a lot of us are visual learners. You're lucky. I've got slides for this. So, let's say you're not registered for the GST-HST. So here's your situation. You bill your buyer or your payer a certain amount of money. In order to carry out that job, you have to incur certain expenses. When they're gone, what's left is your profit. That's what you're going to get taxed on. Now, let's say you do exactly the same job with exactly the same expenses as a GST registrant. So you've billed this amount. On top of it, you're going to charge a tax. And out of this, you're also going to pay for your business expenses, same expenses. Inside those expenses is some GST and HST because most of those expenses you're going to incur here in Canada, so you're going to pay some tax on that. So you've spent that. Now you're going to give the government the tax that you collected and claim back the tax that you spent. So your net profit is actually a little bit higher. And I mention this to point out that there is no mathematical way for being a GST registrant to cost you money. You always end up slightly ahead. Maybe not a lot ahead, but because you get to claim back everything below that dotted line, otherwise would be just out of your hands. Instead, you're getting it back. And so being a GST-HST registrant does not mean that you will lose income. Quite the contrary. You actually get a little bit more income. However, it is a pain. You do have to charge it. You have to keep track of what you've collected. You have to file the return. You have to remit. People don't really want to, and I get it. So when you cross that $30,000 line, maybe you don't feel like registering. I understand. And if you cross that $30,000 line, chances are at the moment that you cross that line, you're the only one who knows you've crossed it. So if you don't register right away, who's going to say anything to you? Who's going to tell you that you should have registered? I mean, your conscience maybe, but like nobody, right? Not yet. And I want to give you a warning about this. You know, I get asked all the time about what will trigger an audit. Will this trigger an audit? Will that trigger an audit? Am I going to be audited if I adjust a return? People ask about audits a lot. And the reality is that audits are actually pretty rare. CRA noticing that you crossed the $30,000 mark, noticing it a couple of years down the line, back registering you and demanding all the tax that you were supposed to have been collecting, that happens quite a lot. It's a lot more common. For some reason, it frequently happens years after the fact, which puts you in a terrible position of having to collect tax that you didn't collect, which you probably aren't going to be able to, but you still owe it to the government because you were supposed to be collecting it. So you don't really want to be in this position. You don't want to not register for a few years because you're leaving yourself vulnerable to being back registered, which is bad. That said, if any of you are now experiencing heart palpitations because you did cross the $30,000 threshold and you didn't register, if you have not yet heard from the CRA, you're fine. Tomorrow, register. Because even though you're late, so long as you register for GST before CRA notices that you should have, you're fine. If it turns out that you should have registered 3 years ago, but you didn't, and you register tomorrow, CRA will not back register you. You just have to get to it before they do. Now, I see questions popping up. I'm going to look at my special questions document and see what have we got here. That link should work. Okay, so the link should be working. So that has always been my link. Okay, I'm going to see what's happening. Now, I feel like there were more questions than I'm seeing in this document. So let me roll up here a little bit in the chat here. Here we go. Can casting agencies add GST-HST on top of commission dues? They always do. They always charge you GST on top of their dues, always. And if you become a GST-HST registrant, you have to tell the casting directors that so that they pay you your GST-HST on top of your fee. They will. Once I have a GST number, because I went over the threshold, do I have to collect forever, even if in further years I'm not making more than 30,000? This is a really common question, and the answer is yes. If your income drops below 30,000, once you're registered, you must fulfill the obligations of being registered until you close the account. Now, if your income drops below 30,000, and it's likely to stay there, you can unregister yourself. You have to basically, once you register, you're supposed to stay registered for at least 1 year. After that, if you don't think it really applies to you anymore, you can close the return. But for the entire period during which your registration was active, you must file returns. You must collect the GST, file returns, and remit what you owe. Okay. Let me check this. Oh, yeah. What's going on here? That's weird. That link does not work. You're correct. I'm going to see if I can give it to you again. Hold on for 1 second. That makes me very unhappy. Because I use that all the time. So give me a second while I get you a fresh link and find out why this one isn't working. Hmm. 1 second. This is really important. All right, give me 1 second here. I'm going to get you a guide that works because it's important.
Sorry to speak up here. It's all good. She had free guys instead of free tax guys as the select.
Oh, okay. Sorry. Now I'm panicking. Okay. All right. All right. Oh, whew. This question about international clients is actually in my next section, so I'm going to skip it. What if you are a service provider, example, a researcher, and you don't have any real overhead expenses? Well, if you don't have overhead expenses, then you don't have any deductible expenses. But I would say that if you're working from a home office, business use of home is kind of a significant, it's a significant write-off, like it's one of the bigger ones actually. And the way that works is you're going to take the cost of your overhead, which is basically if you rent, it's your rent plus utilities. If you own, it's property tax, mortgage interest, and utilities, that sort of thing. And you're going to multiply that by a fraction. And that fraction is how much of your home your office space takes up by floor space. So you can do it either by square footage, like my office space takes up 15 square feet. My home is 450 whatever, 150 square feet. And let's say my office takes up 150 square feet and my home is 450 square feet. So that's like a third. That's what you would do. The other way you can do it is my office takes up 1 room and there are 3 rooms in my apartment. So that's 1/3 as well. Now you can calculate it either way with floor space or with rooms, the number of rooms divided by total rooms. Whichever one gives you a higher percentage is the one you're going to use because it's both of them are realistic. Both of them are allowed by CRA. More questions. How does this apply to an online only business? I'm not clear on what this is in this reference, so maybe you can rewrite that question, be a little more clear about what you're asking. Since government grants are HST exempt, if they push you over the $30,000 line, do you register? They are in fact exempt. As you said, they are exempt from that $30,000 rule. Now, when you file your taxes, CRA does not see a lot of detail, like I said. So for example, if you had a grant of 20,000 and you had self-employment income of 20,000, it will look like you have $40,000 worth of self-employment. If they attempt to back register you, or if they ask you about it, what you're going to do is show that 20,000 of it was in fact exempt and therefore doesn't count toward the limit. They will accept that. We have had artists have to explain that to CRA because CRA doesn't know what the details are until you talk to them. Let's see. I incurred expenses for a gig I did in December of 2023 that paid in January of 2024. Go ahead and write it off in 2023. It's okay. Is there a threshold that needs to be met before it can be considered to be written off? No. No, any expense that is a reasonable, that is deductible under the rules of the reasonable expectation of profit can be deducted. It doesn't matter how small. My doctor is giving me a hard time about signing a disability tax certificate because he says it's really hard to get approved. Well, you know, it is subject. So this isn't really what this tax talk is about, but it is, if it's difficult for it to get CRA to agree to ADHD, that may be true. The doctor may know that. Now, should he fill out the certificate anyway? If he's willing to, sure, why not? As long as he doesn't lie on the certificate. But it is up to CRA in the end to approve it or disapprove it. So he may be just giving you a reality check on that. Okay. What if my partner is also running a business out of the house? And I assume we're talking about business use of home. You cannot occupy the same space at the same time. It is physically impossible. It's one of the fundamental rules of physics. So either you each have your own workspace, in which case you write off your floor space and he writes off his floor space. Or you are taking turns in the space, in which case you can only write off half of the space because you're only using it half the time, and he writes off the other half of the space for his half of the time. But generally, it's impossible for there to be an exact overlap of the space that you're writing off. Do any rules change for self-employed people once they become permanent residents? The tax system does not care about your immigration status at all. They don't care if you're a permanent resident. They don't care if you're a refugee. They don't care if you're a citizen. They only care whether you live here in Canada. If you live in Canada, you are a Canadian tax resident. You're a tax resident for tax purposes. All those other terms of residency, they're totally with the immigration system. And though they sound like the same thing, these two agencies don't care about each other at all. If I work from home but live with a roommate and we split the rent, would I just claim my half of rent and the other expenses like utilities? Yes. You're going to claim what you spend and then a percentage of your half of the apartment, if that makes sense. Just treat it like it's two apartments, sort of, like mathematically. Is there a threshold on the income you need to declare? $50 or $3,000 all need to be declared, even expenses are higher. You declare all your world income. Every dollar of your world income is income from which you are going to subtract your expenses. So if your expenses exceed your income, you've got a business loss. That can actually be very good for you in tax world. A business loss is a tax benefit to you. So all the income that comes in must be declared. If your expenses swallow up most or all or more than that, you're deducting them according to the rules. Reasonable expectation of profit, even if you don't have a profit, you're just going to go and have a loss. But you must declare income no matter how small. Okay. All right. Let's move on. Let's talk about special forms of income. With Of course, a quiz question. Which of these forms of income incurs the least tax? Is it burglary, sports betting, trading in cryptocurrency, hustling pool, or crowdfunding? I'll read those again. It's burglary, sports betting, cryptocurrency trading, hustling pool, or crowdfunding. Which of these incurs the least tax? Does anybody want to guess? Crypto, hustling pool. Okay. I didn't say racing. I said sports betting. Wasn't horse racing. Horse racing definitely incurs tax. Okay, you know what? I feel like I'm seeing a winner here. I'm seeing that the majority of you have said burglary. Let's see how it goes, shall we? All right. So, in terms of which of these incurs the least tax, it is not burglary. The proceeds of crime are taxable. That is actually in the tax code. So theoretically, if you rob someone, you're supposed to report how much you made on that on your tax return, theoretically. It's also not hustling pool. Hustling pool is a job as far as CRA is concerned. You know, it requires a certain amount of expertise. It's not totally open to chance because you're going to get your opponent drunk and you know that you're a good pool player. So no, it's totally taxable. Cryptocurrency, while it is a lot of things that I'm not crazy about, it is in fact taxable. Every time you trade in cryptocurrency, every time you trade, even between two currencies, you are supposed to do a capital gains or capital loss calculation, and any net capital gains are supposed to be reported on your income tax return. Crowdfunding, even though the people have not gotten what you promised them yet, the money that comes in is taxable. It is, in fact, sports betting is considered non-taxable because it's considered to be something that's left totally up to chance. In this country, it's different in the United States, but in this country, you know that your lottery winnings are not taxed. And if you win a sweepstakes, if you win a raffle, none of that has to be reported. None of it is taxable because they're games of chance. And sports betting, even if you're super good at it, you're always right, is considered to be completely chance-based, and so it's not taxable. But let's talk about some other forms of taxable income. I'm going to give you a pause right now. Is anybody hearing this insane hum that is in my office right now? Tell me I'm the only one hearing it, because it's irritating. Oh, fantastic. It is so loud, I can feel it in my feet. But I guess the noise cancellation on Zoom is pretty awesome. All right. So let's talk about those grants. So we've already talked about them. Grants are a big part of your arts, business. It's always a big part of your life. If you're doing your taxes yourself and you use sort of that slip download process that's built into most tax software now, it's going to automatically take your grant income and put it on line 13000 as other income, and it's going to automatically deduct $500, and that's it. If it stays there on that line, you're not supposed to write off any more expenses. The $500 is all you're allowed to write off if you report it on that line. We know that the majority of arts grants are in fact spent in their entirety, because that's the point. So you're going to delete it off that line and put it instead with your business income on a form called T2125. There, I'm putting that into the chat. That is where you put your business income. Don't be fooled because the software seems to know what it's doing. Put it over there in your business income, because that gives you the option to write off all the expenses that relate to the grant income. Okay, so make sure that you're reporting it. It does have to be reported. It does have to come in, but don't report it where your software wants to report it. Now, doing what I'm telling you to do will sometimes surprise CRA. They will see that you have grant income and they will expect to see it on what line 13000. That does not mean that it's wrong to put it on T2125. It is in fact correct to put it on T2125. You just have to show them that you did put it there and that you didn't miss it. If they don't see it on line 13000, they're confused. But if you show that it's on your business income, they're fine. It's just if they don't see it the first place they look, they get confused. But definitely move it. I can't really recommend tax software because I'm a tax professional, so I don't use that software. I use much more expensive software that you cannot, well, you could buy it, but it costs like $500 a year. So why would you do that? Okay. So this question, how do you show it? Do you make a note? As I told you, when you first file your tax return, CRA wouldn't see any of your notes. What they see is that there's nothing on line 13000, but they can see a slip that says you made $10,000 in an arts grant. They are going to either put it onto line 13000 and then send you a notice of reassessment, in which case you have to adjust. You have to talk to them to take it back off again. Or they're going to send you a letter going, we see this $10,000 grant. Did you forget to report it? And then you can get in there before they make any changes and go, no, I didn't forget it. You can see, and this is the point where you show them Form T2125 because they don't see Form T2125. You fill it out, but when you file electronically, they don't see it. They just see the starting number and the ending number. When you want to talk to them about what's on there, that's when you send it to them. And that's the first time they'll ever have seen it. Fun, but true. Now, there was a question about foreign sourced income. So as I've said before, when you are a tax resident of Canada, you must report all your world income, all the income you make anywhere in the world on your Canadian income tax return. And that includes income that you may have made outside of Canada. So for example, if you went, let's say you went to visit family in England for a month, and while you were there, you did some work and you got paid for it. So the income was made in England. You still report it on your Canadian return because you're Canadian based for that year. Let's say you bill a client in the crazy country to our south. Okay, the source of the income is foreign, but it still has to be declared on your income tax return in Canada. Also, oh, by the way, I don't know why this slide, I should have brought this up earlier, but that same link that I gave you before, you'll also get a copy of my GST-HST guide. So everything I talked about with the GST-HST is in that. So you'll get the deductions guide and the GST guide at that link. So I see some questions here. For that form T2125, do you need to do other work to prove that you're self-employed, or can you just fill it? For example, I'm a writer getting CCA grants. You're self-employed because you got grants. You're self-employed because you got money. So you're declaring money. A lot of times you're declaring, when you're self-employed, you're a lot of times declaring money that CRA has no other record of. You're basically volunteering that you have this money. So there's nothing you need to prove. You're self-employed as long as the money is not falling into one of the other categories. So it's not an investment income. It's not employment income. Employment income shows up on T4s. Those are the forms that have tax deducted and CPP and EI. That's T4. Self-employment income shows up either on a T4A that doesn't have those deductions or nowhere. It's just you billed it and they paid you, right? If you have sold goods or services for money and you were not an employee for that money, you're self-employed by default. You don't have to prove anything. But if you only have employment income and you try to deduct business expenses, CRA will stop you on that because you have no self-employment income or business income against which to deduct those expenses. They don't like that. Does foreign sourced income distinguish between salaried and freelance? Yes, it does. So let's say that you do some work for our unfriendly neighbors to the south. If you are an employee, they will issue you a W-2, that's an American form, that's equivalent to our T4. If you are self-employed, they'll issue you no slip or a 1099, which is the equivalent of our T4A. So the W-2 means you're salaried. The 1099 means not necessarily. But the 1099 can report a lot of different kinds of income. If it's income that you worked for, then it is self-employment income. Question, what if you have dual citizenship? As I said, the tax system does not care about your citizenship. Our tax system, the Canadian tax system, does not care about citizenship. Like almost every tax system on earth, our system only cares about where you typically live, your residential ties. The one country that cares about your citizenship is the country to the south of us. They are the only ones who require you to keep filing tax returns even after you leave. Even if you were taken out of that country when you were 18 months old and you've only known Canada, if you have citizenship in the US, you must file returns there as well. They have their own special rules. Nobody else really cares. Does a scholarship from a university in Canada count as self-employment income? No, it does not. No, it doesn't, because you're not selling a service. Nobody has received something from you for that scholarship. However, if the scholarship relates to paying your tuition for full-time school, it's not taxable. Usually it's maybe reportable, but not necessarily taxable. If it's for part-time income, it's like partly taxable. So it's income, but it's not necessarily taxable. But no, there's no business expenses. You didn't, yeah, you did, no, it's not business. If you're doing some tax work if you're doing some work in the US, do you have to file a US tax return as well as a Canadian return? No. If your US payer is withholding income tax on you, you may want to file a return to get some of that tax back, but that's between you and the IRS. You absolutely do not have to file anything. They are supposed to be withholding tax if you owe any, and as a Canadian tax resident, really you don't. So, so no. Let's see. Does crowdfunding for donations versus in exchange for goods matter? Is it all employment income? It's not employment income. It's self-employment income. Yes, crowdfunding is income. You're getting income, you must get taxed on it. Income from any source, from a job, from a bank account, the interest on a bank account, from the sale of some stocks. Income of any kind except for inheritances and gifts are taxable. So it doesn't even matter that it's not really self-employment or it is or it isn't. It doesn't matter. Either way, it's income. It has to be declared. So you could put on line 13000, which is other income. It's basically a sort of a catch-all line for any income that doesn't fit on another line, but it has to be declared. Yeah. I file my own taxes, but find the forms related to its self-employment confusing. Would a tax preparer ever teach someone how to complete the forms, assuming I don't hire that preparer to do it for me? So when I hire somebody to work for me, I vet them first to make sure that they understand income taxes. And they understand more than a layperson does about income taxes. And even so, I train them to do self-employment taxes because it is such a big part of our clientele. The course that I give them, it's got 110 pages of text. It's got 7 hours of video, and it takes over 40 hours of study to complete. So if you want me to teach you how to do your own stuff and to be decent at it, that I feel like you would be a beginner, you'd be able to step out there as a beginner, and you want to pay for that course, sure. It's 42 hours long. Let me know in the comments what you would pay for that course, because I have thought about making it public. So I will make it public if people think it's worth doing, but it's not something that you're going to sit down in an hour and a half and then just know how to do. The forums themselves will tell you stuff. If that's not enough, you need to go deeper. Okay, so here's what I'm going to do. It's 7:15. Let's take a little break. I know that people have, like biological needs. Um, let's take a break. It's 7:13 according to my computer here. Can we reconvene at 7:20 while everybody takes a little breather and just absorbs? And I'm going to look at some other questions and see if I can answer them when we come back. Okay, so let's just take a break. That's okay. Okay. According to my clock, we are back. So I have been answering some questions in the chat. Um, if you go to the chat window in the upper right corner with the three dots there, one of the options is save chat, and it will actually save everything in the chat to your computer, so you can refer to it later. So if I yeah, if you want to make sure that you got all the answers to all the questions, maybe near the end here, save the chat so that you can refer to them later. So there were some questions about reporting grants, questions about earning residuals, questions about what if I earn income and I don't have anything to prove that, and so on. I'll try to answer some more as we go, but just so you know, save the chat and you'll get some answers that I answered over the break. Okay. Okay. So there was a question about, when you file a return and you get money back, is that taxable? And it's not, because refunds, what happens when you file a tax return is you're reporting all your income, and it is when you complete your tax return is the first time that your tax bill has actually been calculated. Until then, nobody has known what you owed in tax. Now, if you have a job, if you're an employee at some point, they are withholding tax for you at source because they are legally obliged to do so at a legally mandated rate. The percentage that they set aside for you is set by the government, and it's sent to the government and then held for you. When you do your return and you file, your tax bill is calculated, and then it's compared to the amount of tax that was set aside for you. If the employer set aside more than you needed, you get the rest back as a refund. And if they set aside less than you needed, then you owe tax. Now, what happens if you're self-employed? Because employees, somebody withholds the tax before they get a hold of the money so that they can't spend it. And then at the end of the year, if that's too much, they get it back as a refund. It's like found money. They never really have to worry about setting aside money for tax, because usually the amounts that are set aside by their employer are enough or more than enough to cover their tax bills. So employees who are just employees don't really have to worry about it. But when you are self-employed, you are your own employer. That's self-employment, which means that you have to withhold your own tax. In practical terms, it generally means that whenever you're making self-employment money, you have to set aside a certain amount of it for future taxes. Question is how much? And the answer is, I don't know. You, as a self-employed person, are not taxed on how much money you bill. You're taxed on your profit. The profit is what's left after you subtract your business expenses. And you don't really know what your business expenses are going to be until the year is over. And so you don't know what your net profit is going to be until the year is over. And so there's no way to know exactly how much tax you're going to pay until the year's over and you've had a chance to do all these calculations. What I can do is give you an approximation. And that is that for most of the clients that we work with, when all the calculations are done, most of them end up owing between 15 and 20% of every dollar they build back out in taxes. So for most businesses selling services, you can pretty much say, if I set aside about 20% and just put it somewhere and don't spend it, that will probably cover your tax bill or be close enough that it's no big deal. The exception is if you do the kind of job that's basically just you and your brain. So writers, consultants that just basically, if all you do is sit in front of a fairly old computer and write stuff, that is a very inexpensive job to do. You're not going to have a lot of deductible expenses, which means that for every dollar you bill, you're keeping a lot more of it as profit, which means that your tax bill is going to be a little higher. So if you do one of those, it's really just me and my brain jobs, set aside 25%, not just 20. Everybody else, start with 20. As you go through your business and sort of like look at it from year to year, you might be able to sort of zero in on a number that's more effective for you, but 20% is a good place to start. Now, where are you going to put it? Well, there's no legal rule about where you put it. There is, however, a mental rule, which is that it's really hard not to spend it if you can see it. It's hard not to consume what you can see, particularly when you're a little hungry. So my best advice to you is to put it somewhere where it's a little harder to get at, like equivalent to putting the cookies on the top shelf of the cupboard, just to make it a little harder to get at. I like online bank accounts, the kind that you don't use all the time. If you have another bank account out of which you pay your bills and your e-transfers and stuff, and that's your sort of like your day-to-day bank account. If you have a separate bank account, online accounts are free. So that's, useful, where you're just going to sock money so you don't have to see it anymore. You're going to put the GST and HST you collect plus that 20% from your fees. Because remember, you're going to have to remit some or most of that GST figure as well. So get that out of the way. As soon as you collect GST, get it out of the way, put it out of your reach, and then take 20% of your fee and put that out of your own reach too. And you should have more than enough set aside to handle the tax bill. It's very rare that won't be enough. Tax trivia time. What does this woman who lives in she lives in Jersey, not New Jersey, not like the American state of New Jersey, but Jersey, which is an isle in the UK. What does she need in order to discuss her tax situation with the government? What does she need to have? She looks puzzled. She's got some stuff. She's got mixing bowls and eggs. And does anybody want to guess in the chat what she needs? What does she need? Anybody want to guess what she needs? There we go. She needs a man. Nothing. She does not pay tax. Probably man. Well, I will say she is wearing a wedding ring. So she does have a man and she is married. But that's not enough. She wants to talk about her own taxes with her own government. What does she need? Statement of income and expenses along with receipts and bills. Very modern. This is not the answer. Okay. Here is the answer. Are we ready? The answer to what she needs in order to discuss her taxes with her own government is, of course, yes, his written permission. She needs his written permission to do this. Now, of course, that was the 1950s. That is not the law anymore. That is not the law. She no longer needs her husband's written permission to talk about her own taxes. Does anybody want to hazard a guess as to when that law changed? We know it was in place in the 50s. Till when? 70s. 1975, like 1980, like long after it should have been, right? Like long after it should have been struck from the books, it was still in place. Seems to be, yeah, obviously, exactly. Yes. Yes. Way too late. That is correct. The correct answer is way too late. But the precise answer as to when this law changed is 2020. That's when the law changed. So, yay, feminism. Anger. I know. There is tax in Jersey. It's part of the UK. It's one of the most heavily taxed regions in the world. Okay. So I also wanted to talk to you about filing deadlines. Now, this may seem like a little bit of a letdown, filing deadlines. We all know about filing deadlines. You don't. The first thing you need to know about filing deadlines with the Canada Revenue Agency is that they matter. Deadlines matter more than you think they should. The Canada Revenue Agency is run by bureaucrats. And bureaucrats love paperwork. It's what they line their nests with. And if you really want to make a bureaucrat itchy, don't give them the paperwork they want. Making a bureaucrat wait for paper is worse than making them wait for money. Bureaucrats are not paid on commission. Of course, the tax system is about money. Of course, the money matters. Of course, it's all about money. But in the workings of CRA, they care at least as much about receiving documents as they do about money. And so a lot of times I find that when people get contacted by CRA, because their mind goes straight to owing money, they don't necessarily comprehend what's written on the page, which may be, we would like to see a receipt, not money, right? People always assume it's about money, but it's not. Frequently, it's about a document. Or they'll say, why are they, like a lot of times, for example, the most common reason that a bank account gets frozen is because you're behind on your GST filing, not the GST payments. So a person may say, I paid them, I remitted all the money. Yeah, but did you file the return that went with that money? Because if you didn't, they'll freeze your bank account because they don't have the return. Now, besides the fact that that is a practical reality, that is true. Bank accounts get frozen because you didn't file the paperwork, even though you paid them. There are two ways that you pay if you are late. If you are late filing paper, you get fined. It's called a late filing penalty. If you're late giving them money, you're charged interest because you made them wait. Like basically anybody who bills you charges you extra if you make them wait. In the CRA world, the late filing penalties are actually much bigger than the interest rate. The penalty for being a day late with a return is a lot higher than being like a month late with the money. That's absolutely true. And so by the size of these two things, these two amounts, that the penalties are bigger than the interest, that tells you that they value the paperwork as much, if not more, than the money. And so if you're ever in a situation where, you know what, I've told you to set aside money for tax, but you didn't know that before, and so you didn't do it. And so now you're filing, you've done your return, but you're afraid to file it because you can't pay, file it. File on time, even if you can't pay on time. Because if you wait to file and you're late, your bill increases sharply, hard. Whereas if it takes a while to pay it off, your bill increases slightly, slowly. Get the paperwork in. Worry about making the payment later. Even if you can't pay, please file on time. And that filing deadline is, of course, not April 30th because you are self-employed. If you have any self-employment income at all that you're declaring on your tax return, you automatically get a deadline extension to June 15th. It doesn't matter how small your self-employment income is, any self-employment income. It doesn't matter if you didn't make a profit. If you have self-employment income, you get until June 15th to file. Not just that, your partner, your spouse or common law partner also gets until June 15th to file. Happy little benefit of being self-employed. Now, let's take a quick look at my question sheet. Let's see if we've got some good questions here. If you end up not earning much, should you still add expenses to income tax? And what effect does this have? Or where do they go if you have no taxable income to lower, especially with CC? I don't know what CC is. Canada Council? I don't know. I mean, the Canada Council grant, if you're asking about no taxable income to lower, especially with CC, if you mean the Canada Council, that is taxable income. If you have no self-employment income, if your income was zero, I don't recommend trying to write off expenses and bring that to a negative number. But if you have income and you have expenses that will bring that down to a negative number, or you have some income, it's not enough to make you taxable, but you also have expenses, I would say generally write off the expenses if they're legit, because low income can have other benefits, like can get you credits, like in Ontario, you can get the Ontario property tax credit, which is just free money. The GST credit, free money again. There are weird places. There's sort of a weird edge case where you actually want your income to be a little higher because you get a slightly higher credit. But for the most part, you usually want to reduce your taxes as much as possible. You want to reduce your income as much as possible because in all except these edge cases, it's a good idea. So do write off the expenses, even if you already don't owe tax. it can have benefits in other ways. Can I claim an expense without a direct receipt to prove it? Yes, but you're going to be taking a chance. If you get audited and you can't produce the receipt, you're going to lose that expense. But that's if you get audited. We'll talk about audits in a second. I have been filing my taxes for years, but I'm unsure I'm doing it right. If I were to hire a CPA next year, how do I organize all my data for them? I doubt my Excel spreadsheet would be intelligible to someone other than me. We are tax preparers. Got to be careful with CPAs too. Like, you can have a tax preparer who's not a CPA. I am a tax preparer, not a CPA. And as a result, generally, we're a little cheaper than most CPAs. So just to be aware, I don't know that I've ever met a tax preparer or a CPA who knew more than I do, because I've been doing this and only this for 20 years. So just get a professional tax preparer who may or may not be a CPA. I just want to say that. And for us, we have something called the workbook that we give to our clients, and we ask them to transfer all their figures, whether they're on paper, whether they're in a spreadsheet, whether they're on the back of old envelopes. We ask them to put them into our worksheet, which is, it's been designed to be fairly self-explanatory. We've got a lot of clients from a lot of different walks of life, some of whom are dancers, and they all sort of figure out how to do this worksheet. It's not complicated, but we do ask you to put it into our format. And that way we don't have to figure out your Excel sheet. You already understand your Excel sheet. We will teach you our Excel sheet, which is pretty straightforward. Like, what did you spend on, what did you spend on bus rides? Put it here. You're just going to transfer stuff over. And that way we don't have to interpret your spreadsheet. I don't know about every tax preparer, but I know that we're not the only ones who have our own system that we ask you to use. Yeah, so that's how that works. What about putting aside for HST? As I said, as part of your set aside all the GST or HST that you collected. You know that you have to remit the GST and HST minus the GST or HST on expenses. That means that if you set aside every dollar of GST, HST you collected, there's no doubt that you will have set aside as much, if not more, than you need to. So stay on the safe side, set aside all the GST, HST that you collect. At the end of the year, if that turns out to be more than you need to remit, which it typically will be, you've created a little refund for yourself. Take the rest and drink it, or whatever. Is there any advantage to filing the old-fashioned way with paper rather than online? Not a single thing. Not a single thing. All you're going to do is make a bunch of arithmetical errors. It's going to take longer to get your notice of assessment, because a human being is going to have to go through your return and enter it. They're going to find a bunch of mistakes. They could make a typo transferring it into their system and end up screwing you over that you're going to have to go back and fix. No, there is absolutely no advantage to filing on paper. Please don't do it if you don't have to. How do I prove income from sales? That was a question that we got in the chat. If you have income from sales, you're basically declaring income. If you're declaring income on sales, you're declaring income that until you declared it, the Canada Revenue Agency had no evidence of it at all. They didn't know about it, right? That is not the thing they scrutinize. Like, oh, you're volunteering. You said you made some money, so you're volunteering to pay tax. Prove that you actually owe tax. They're not. That is not what they scrutinize. What they scrutinize is the things that bring your taxes back down. What you want to have evidence of is your expenditures in case you were ever audited. You don't necessarily need proof that you earned income. You want that if you're trying to get a mortgage. You don't want to lie about income if you're, you want to be able to prove income if you've got a mortgage. But CRA, it's all good to them. Sure, declare as much as you want. Declare too much. They don't care. All that's going to happen is you're going to pay more than your share of taxes. They're okay with that. Believe it or not, they're fine with you overpaying. If you want your income to show higher, do you have to include expenses even though they are related to your business? No, you don't have to deduct a darn thing. You have the option to deduct expenses to bring down your taxes, your tax bill by bringing down your net profit, but there is no obligation to write anything off. Is a bank statement enough proof of an expense for an audit? Yes, if you paid via the bank, so by check or by e-transfer, so that the bank itself has evidence of the money moving away from your control and over into somebody else's, that is satisfying. That is satisfactory proof. Although in general, they prefer receipts. And I will talk about that in the next section. Okay. So the next section, as I say, people ask a lot about audits. Let's do a quiz question. Which do you think is the most common trigger for an audit? Is it claiming a business expense that isn't valid? Is it significant changes in income from year to year? Is it business losses from year to year? Or is it dumb luck? Which is the single most common trigger for an audit of these four things? B, 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 D, D, D. Okay. Okay. Anybody else want to chime in? C. Okay. Does anybody want to say A? Okay. I'm glad nobody said A. Don't say A, because I already told you that CRA can't see what your business expenses are. So by logic, you know that it's not A. And a lot of you got this one right. The answer is dumb luck. Dumb luck is the most common reason that you get audited. The most common trigger of an audit is that CRA discovers that something is being misreported in a specific industry or a specific situation. And then they go and they find everybody who's in that industry or in that situation, and they pull a certain percentage of them and they audit them. So you get caught up in a sweep is the most common reason that you will get audited. It's almost not ever something that you do. And in that way, it's basically like a tornado in that there's nothing you can do to prevent it. But the consequences of an audit are a lot like a tornado too, in that two people can get audited and one of them is destroyed and the other one comes out fairly intact. And the question then is, why did that happen? Since you can't avoid the audit, how do you be the intact person and not the destroyed person? And the answer fundamentally is your record keeping is what protects you in the event of an audit. An audit comes from the same root. The word audit comes from the same root as auditory or auditorium, and it means a hearing. CRA is going to ask a question and listen for the answers. And your answers are actually in your records. They're going to ask for supporting documents. They're going to ask for proof, again, mostly of your expenses, not of your income. And great records will support the deductions that you made. To be great, they have to be complete. They have to contain anything that CRA might ask for. You have to be able to find those receipts that they ask for, because if you've got them, but you can't produce them, that's no good either. And they have to be accurate so that what you reported is in fact what's on your tax return. So by being complete, everything is there. That means that you've kept everything you're supposed to keep. By being findable, they're organized in a way that you can find them, even when your memory no longer serves, because I promise you, at the time that you get audited, you will not remember where the receipt is. So you're going to have a good system of storing them so that you don't have to remember. You can just follow your own logic and find it. And finally, of course, what is in your records should be reflected accurately in your return, but that kind of goes without saying. So what exactly are you keeping? What exactly do you have to have? So the first question I always get in this is, can I just keep a credit card statement instead of the receipts? And the answer is no, not really. It's not that it won't work at all in the case of an audit. It's that CRA's rules say that they don't have to accept it as adequate proof. What they want is a document that shows the amount you paid, the date you paid it, and the name and the address of the vendor. And that is typically not on the credit card statement. Where it is on the vendor's receipt. So while you can use a credit card statement to keep your to make sure that you didn't miss anything. It is great for keeping all the information sort of together, particularly if you have one credit card that you basically only use for your business and a different credit card that you use personally. That's not necessary, but it does make things very clear. It's very easy for you to make sure, oh yeah, I paid this thing. Where's that receipt, right? For your own sake, it's nice to have the credit card statement, but in the case of an audit, you want the vendor's record that they sent you after you paid. So that can be a cash register tape if you bought it in person, an email receipt if you bought it online, or if you have something like a a cell phone bill and you're trying to write off some or all of that. You want to have, if they don't bill you, if they don't send you an invoice every month, although they kind of should, but if they don't, then have at least the agreement on hand in case you need to prove how much you spend on that. And how long do you have to keep it? Well, CRA can go back up to 7 years from either the tax year or the year in which you filed the return. So why am I making this distinction? So if you're up to date with your filing, at this moment, they can go back. It's 2025 right now, so they can go back as far as 2017 and ask you for a receipt to prove something. They can go back to 2017 and audit you. But if you're late filing, let's say you're just catching up now, and you file the 2016 return like right now, they can still go back and audit it. It's more than 7 years ago, but now that you filed it, the clock starts ticking again. So now you've got another, basically it's actually 6 years, 6 years from when you file. So if you file your 2016 return now in 2025, they can go back and ask about that for any of the next 6 years, or next 7 years. No, next 6 years, 2026, 27, 28, 29, 30, 31, 32. They can ask about the 2016 return until 2032 because you filed it in 2025. So that means that for 7 years, you're responsible for being able to produce the proof that they ask for. And if you don't, now, if you can't produce a receipt, theoretically, they could say, oh, you lied about this. That's tax evasion. We're going to fine you horrendously. We're going to punish you for this. But realistically, especially if you're like a small operator, which most of us are as a single person, doing a job, they're probably not going to go that far and say that you did it intentionally. They're just going to say, wow, you're a mess, and say, we cannot let you keep deducting this expense. So what they'll do is they'll remove the expense from your return, which essentially will increase your net profit by that amount. So you were bringing your net profit down, by a $10 receipt. So they have to, if they ask for that receipt and you can't produce it, they put the $10 back on your return, and now your profit has risen by $10. And so your tax owing is going to rise accordingly. So you're probably getting taxed at about 30%. If your income rises by 10%, by $10, you're going to pay an extra $3. So you'll end up paying back the tax that the expense originally saved you if you can't produce the proof when they ask for it. So bear that in mind if you're trying to write off an expense and you don't have the receipt. If it's small and you're willing to take your chances with it, because it's not going to fundamentally change your life if they remove it from your return 7 years from now, go ahead, declare it. If you know it's real, but you don't have the proof, don't let the fact that you don't have the proof keep you from deducting an expense that you know is legit. But be aware that you're always taking a bit of a chance. The tornado could hit you, and if they ask for that specific receipt and you don't have it, you can lose that deduction. So the bigger that deduction is and the more of an impact it has on your return, the bigger a problem it's going to be if it gets disallowed. So the bigger the expense, the more important it is that you have the receipt. The smaller the expense, the less it really matters. If you just kind of know, you saw it, it's on your credit card bill, it's $5. You know it was a business expense. You're going to write it off even though you don't have the cash register tape. It's probably fine. It's not really going to get you into trouble. However, I will say that if you're caught up in an audit, and if you don't have 1 or 2 receipts that they ask for, probably not a problem. But if you don't have 50 or 80% of the things they ask for, they ask you for A, B, C, and D, and you've only got A and the rest are missing, they're going to say, wow, this person's a mess. I wonder what else they missed. And that will trigger further audits. So they might start by auditing one return and asking for receipts. If you're a mess, they're going to say, let's do 3 years, let's do 7, let's do all of them, right? If, on the other hand, you've got 90% of what they ask for, they're going to say, yeah, she's all right. We're probably not going to find much if we go back any further, so we're not going to bother. That's how you come out intact. You don't have to have perfect records, but the closer they are to perfect, the less likely it is that things are going to be a big deal. So what you really want here is good financial hygiene, which is that you want to regularly put away your receipts. You want to sort them at least once a year, more often if there's a lot of them, and you want to have them ready for 7 years in case Sari ever asks to see them. So my point is here that financial hygiene is like dental hygiene. It's not exactly fun. There's almost always something you'd rather be doing. But it's also not a big deal. And it can save you so much trouble down the road. Just do it. Just do it anyway, rather than have a root canal or gum disease or whatever. Just do it, even though you hate it, right? Financial hygiene will save you if and when the crisis comes. Now, there is one other trigger of audits that sometimes hits people in the arts. So the second most common, does anybody want to guess what the second most common one is? Well, it is in fact business losses. So a net income of a negative number. So maybe you billed 10,000, but you spent 5,000. So your net profit is negative 5,000. That is one of the, remember I said that when you file a return, CRA doesn't see everything. They just see main numbers. Well, that one, your net profit from your business is one of the main numbers. So they can see those negative numbers. All businesses have ups and downs. And it is understood, particularly when you're new at something, that there are going to be years where you invest or spend more than you earn. And that is going to produce a loss. Losses are always sort of a known hazard of any kind of self-employment, any kind of business. So a loss is not automatically a problem. But a series of losses may be, because this idea of the reasonable expectation of profit is also frequently applied to businesses as a whole. And if you have loss after loss after loss, it starts to look that like even in the long run, you're never going to break even or you're never going to make a profit. And if you are, that's something that CRA wants to look at. So the question that CRA would have if you have a series of losses is this really a business? And they will send a questionnaire, actually. This is an odd kind of audit where they send a questionnaire and they ask you about your business. And they're asking to find out if you're a professional artist. When artists see that, what they think they're being asked is, am I just an amateur, am I just doodling here? Or am I a serious capital A artist? And they start to talk about how many galleries showings they've had, how many times they've been featured in magazines, the professorships they hold. They think that this is what CRA is asking about. Are you real? Are you a true artiste? Or are you just some amateur? But that's not what they're asking. CRA doesn't care about your credentials as an artist. They're asking, are you pursuing art for art's sake, or are you trying to make a profit? And if you are serious about making a profit, then that's a business. If you're not serious about a profit, then it's not. So the mistake that people make with that questionnaire is, and I'll give you an example, a specific example. This was somebody who was not our client. If she had been, I would have given her advice. She got the letter and it said, basically, how much do you care about profit? And she said, my goal is to advance the cultural conversation of Canada. I don't care about profit. So the question she was hearing is, are you a real artist? And her answer is, yes, I'm a real artist. I don't do it for the money. I'm a real artist. But that was not what CRA was actually asking. They were asking, sure, you do art, but do you do it as a business? And by her saying that, no, I don't care about profit, it's not a business if you don't care about profit. And if you don't care about profit, you're not allowed to deduct stuff because that negative number on her business income, so she was showing negative 5,000, negative 13,000. She was not living on negative $13,000 worth of money. She had a job as a professor. So she had income. By having a loss on your business, what happens is the two numbers are combined. So she was making maybe 70,000 as a professor, losing 10,000 in her business, and so getting taxed on 60,000 because it was $70,000 of teaching income minus her business loss. By doing that year after year, she paid far less tax than she would have if she hadn't declared the business losses. And CRA is saying it's not a business. You cannot use it to reduce your taxes. It's a negative number because you don't care about it not being a negative number. And therefore, it's something you do for your own reasons. And therefore, you can't pay less tax than a professor who doesn't do art for art's sake. You have to pay the tax on the money earned. So this created quite a problem. So if you are ever subject to this kind of audit, whatever you do, never indicate that you don't care about money. I don't care if you don't care about money. Don't tell CRA you don't care about money because you will lose. And what happened to this person who said she didn't care about money is that they disallowed all her losses, which meant that they went back to every return, took that negative $10,000 or whatever, put it back into her income, and there's tax on that. Plus 10,000, plus 5,000, plus 15,000. Every year she had a loss and she deducted that from her income, they put it back and that increased her taxes. And now this happened. They did a string of years. Now she owed a lot of money in tax. So never, ever tell them that you don't care about money. You have to care about money. It's okay to have business losses. It's even okay to have a lot of them, but never tell them that you don't care about money because that's an automatic disqualification. They may disqualify you anyway. They may say, well, yeah, you may care about money, but clearly this business is a wash and we don't really take it seriously anymore. So forget it. You may still lose, but you will definitely lose this kind of audit if you tell them you don't care about money. So please never do that. Now, it is 2 minutes to 8. That is not a lot of time for questions. In fact, it's no time for questions. I hope that I answered as many. I did answer as many as I could. If I can, I will try and send some of these other answers to Hamilton Arts Inc. and get those answers out to you. We'll see. It is tax season, so I really can't guarantee anything. Thank you so much for having me. It's been a real pleasure. I've really enjoyed the questions. I've really enjoyed the chat and your engagement in this event. And I hope to see you again at some future event. And with that, I'm going to hand it back to Hamilton Arts Inc., my lovely hosts.
Thank you so much, Sunny. That was so informative, and thank you so much, everyone, for joining us. And there were a lot of really spirited, interesting questions. So many. So thank you. Thanks everyone for sticking around for 2 hours to talk about taxes, It's really important information. And we've recorded tonight's event for folks who arrived late or anyone who needed to leave early, or who wanted to pass along this information to an artist, self-employed friend. So we will send that out to everyone who registered tonight, and we will also post it on our website, and that'll go out through our newsletter. Yeah, and we'll also send that along to Sunny, and so it'll be around. Good luck with your taxes, everyone.
Stay cool.
Stay cool.
Do your hygiene a little bit at a time.
Do your hygiene. So thank you so much, everyone, and have a great evening. And thank
Good
you,
night,
Sunny.
everybody. Bye.